Today I'm going to be showing you guys how I actually got a payout with the trading pit, a payout worth $1,500. You've obviously seen a lot of videos here on YouTube where traders show how they pass challenges whatsoever, but obviously most traders blow the account shortly after. And in this video, I'm going to show you how you can actually get a payout using my simple trading strategy that I'm going to be showing you here in today's video. Now, without further ado, let's just dive straight in. All right, we're going to start here on the daily time frame on NZDUSD, and the most important thing that we're going to start with is market direction. So again, like I said at the beginning of the video, there are four main confluences that I like using, and the very first confluence is going to be market direction. Now, when identifying market direction, what you always want to be looking for is, hey, is the market trending in towards the downside, or are we trending in towards the upside? Now, as we can see on NZDUSD, since around the 25th of June, so since the summer, the market has been trending in towards the downside. So I was looking to further capitalize on that overall downside momentum. I was at no point in time looking to take any longs because I clearly saw, hey, we are currently forming lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and I was simply looking for the next lower high to then again form a new lower low. So with that in mind, what I then simply did is I identified, hey, what is then the overall order flow / supply zone that is currently in control? Well, that is always very simply identified by looking for the overall, let's say, buy up for the strong sell down. Now, when we've identified market direction, we then want to identify number 2, supply and demand, and number 3, we want to identify liquidity. Number 4 is going to be PVD, and number 5 is going to be opens. Now, we've discussed number 1, we understand, hey, market direction is bearish. We're looking for further shorts in towards the downside, which is in line with what I just explained, the lower lows and the lower highs. Step number 2 is identifying our area of supply. Well, as we can see here on the daily, we have a clear buy up for a strong sell down. So we're simply looking for the market to retrace in towards there and then again continue pushing in towards the downside. Now, when we look at liquidity, I always just go down one single time frame. This is very important because when you go down a time frame, it always becomes slightly more clear where you actually have those points of liquidity from where you're going to be looking to trade from. Now, identifying liquidity is relatively simple because all we're going to really do is look at an overall impulse, because when we had, again, market direction, which was the first confluence that we just discussed on the daily, we can also use that, by the way, here on the 4 hour. We identify, we have our break of structure. Now, when we have our break of structure in towards the downside, we can then identify, here we have a swing high, and down here we have our overall swing low. So with the overall market structure identified as bearish on market direction, then number 2, we have our daily area of supply, which is the buy up for the strong sell down. Number 4 was the PVD, which is the premium versus discount, where we simply want to be selling above the overall 0.5 fib. All we simply need to do now is identify liquidity and then an additional supply zone here on the 4 hour time frame. Now, as I just mentioned, the easiest way to identify an area of liquidity is by looking for bumps in the road within the overall impulse down. Now, within the overall impulse down, here we have a bump in the road, here we have one, and here we have one, and here we have our final one. So these are pretty much the 4 bumps in the road. Now, Fabio, how do you then know when the market is actually ready to pretty much sell off? Now, that's when we use, 1, the PVD tool. So we always simply look for liquidity highs which are above the overall 0.5 fib retracement, and this is improves the overall, let's say, probability of that liquidity high playing out. And number 2 is waiting for a change of character when the actual liquidity high gets taken. And a change of character is nothing more than a market structure shift based on the individual candlesticks. And kind of like a bonus confluence that you can use is confluence number 3, where we use the opens indicator, and the opens indicator is very simply said the opens by SPTNC. So daily, weekly, monthly, yearly opens by SPTNC. That's the preferable indicator that I like to use. And what it will show you are the monthly, the free monthly, and the yearly opens. So what you have here, let me just clean up the charts again, is the monthly and the free monthly open. So the M and the free M open aligning. This is always going to be the highest probability area to look for a potential short from, especially if it aligns, for example, with an internal liquidity high and with the fact that it is currently situated within premium pricing. So from that area, more specifically, I'm going to be looking for a potential short position. Now, what we saw at the time was that the market was moving relatively slow. And to be very honest, I was actually already looking for a potential short position from this very first liquidity high, because we were building up this high and this high right below this high over here. So I understood that there was quite a lot of liquidity resting right above this overall high. Now, at the time, what happened is that the market actually pushed up in towards that high and gave us a change of character down, meaning that we saw a break here. So we saw a break in towards the upside, and then we saw a break in towards the downside, forming an overall area of supply within this piece of price action. And I actually took a first sell position over here with pretty wide stop loss, just around above the monthly free monthly open, targeting again a new lower low. Now what I personally did was that when the market started pushing up higher like it did here, I closed that initial position for a loss. And what I then did is I waited for the next liquidity high to get tapped, together with price action moving closer towards the monthly / free monthly open. Now what happened is, again, we can see the market pushing up higher and higher, and this was also the week of FOMC, where Jerome Powell, the head of the Federal Reserve in the United States, was going to be speaking on monetary policy. So I wanted to wait what his policy decision was going to be, and based on that I would have more conviction in the overall trade that I was going to take. So what we saw here at the time was that the market pushed up and up and up, rejected the monthly and the free monthly open, and this took place on a Wednesday when that Fed speech was actually taking place. Now in that speech, Jerome Powell was relatively hawkish, saying that a December rate cut was not confirmed. Now this is very bullish for the dollar overall, because lower rate cuts mean that the dollar is likely to weaken, as people are less likely to invest their money into dollars because return on their money or the capital invested goes down. Higher interest rates will deliver a higher return on your invested capital. So that's why a hawkish speech, during which Jerome Powell leans more towards, let's say, stopping the overall cutting of interest rates, is bullish for the dollar. Now, together with the fact that that was said on that Wednesday, which caused the overall initial spike down, with the rejection of the monthly free monthly open, with the takeout of the liquidity high, with us retracing into premium, and with me understanding that we were situated within an area of daily supply, and with now the fractal confirmation being a high break and then a low break, together with also the weekly open, I was happy to take that short position on top of that supply zone, stop loss above the highs, and then targeting a new lower low for at least a 1 to 2 risk to reward. And that is the moment that the market then decided, hey, I'm ready to continue pushing down lower in towards your TP. And that, ladies and gentlemen, caused me to get a $1,500 US payout here on the trading pit account with NZDUSD shorts.